Welcome. My name is Kristen Kolish. I am a retirement plan advisor with Raymond James. And many of you who have registered have been on our periodic programs in the past on various topics of interest. We've worked with SHRM where we can offer CE credit. So I'm just going to start with some housekeeping items. If you're interested in SHRM PDC credit, you do have to stay on the program for 50 minutes. And then by the end of today, you'll receive an email from me with the code for your information and tracking. I also will be sharing a copy of these slides. So I'm going to ask you to listen and think about the topics that I'm discussing and think about how it applies to your organization. You don't feel like you have to take copious notes on anything because the materials will certainly be shared. I want to thank you for joining on December 19th. It feels like the end of the year because so many folks might be taking some time off the following 2 weeks. I know for many of you in HR and for business owners, the end of the year can be just as busy, if not busier than any other time. So kudos to you for making the time to join this program today. We will be making a recording available as well, so you can feel free to share that with colleagues that you think might benefit from the information. So the fourth quarter of the year tends to be the time where we really talk about benefits. Many organizations have open enrollment for their health plans. If you offer a deferred compensation plan to your highly compensated employees and your executives, that's enrollment that needs to happen before 1/1, before the receipt of income in 2026. So the fourth quarter can be a really busy time of year. And if you think about it from your employees' perspective, whether it's a 401k, and I'm going to, we'll be talking about a few things today. I'll jump around a little bit, whether it's a 401k or your health savings account associated to your medical plan enrollment, or other retirement plans like a cash balance, deferred compensation plan, we tend to communicate about the benefit, about the features of the benefit, which inadvertently is encouraging us to think about them in silos. But if I take off the benefits hat and I think about my financial planning hat, they're all tools in our toolbox to help you and your employees make progress on their own financial futures. And I have been an advisor for well over 20 years. And in the beginning, I worked almost entirely with 401k plans, and now I work with a whole host of other benefits, including with individuals. And the one observation I'd make is that the expectation of the employer is different today. It's not just to offer these benefits, but it's to get your employees to connect the dots and think about how they should be using the benefits in tandem. And perhaps even, and this might be an over-exaggerated expectation of you as employers, and I get it, helping them make sound financial choices. And why is that? Well, most of your workers, most American workers, lack any type of financial training, right? It's on the job financial training. So the idea of having sound financial skills from managing an income, your paycheck, sitting on expenses, weighing the pros and cons of various debts, all of that falls way outside the purview of employer benefits, but they impact and they inform how your employees are positioned to use the benefits that you offer. So I cannot overstate enough how important this topic is to me personally. I'm pretty passionate about it because at the end, it's how can we evaluate the options using this financial wellness mindset. So I'm actually going to take myself off video as I continue to present the rest of the program. You can feel free to throw questions into the Q&A and I'll answer it certainly at the end, but throughout to the extent that it's applicable to the conversation that we're having. So let's start at the beginning, and we're going to start above all of the benefits that I've spoken about, to give you kind of a lay of the land on why I truly believe that this is such a good time to be reevaluating your benefits offering. And why is that? from one perspective, it's very finite. There's legislative things that are happening that, like, in this moment that you should be planning for. I know the program is beyond the 401k, but as it relates to the 401k, for instance, now kind of the rubber's meeting the road when it comes to Secure 2.0 requirements. The fact that starting next year, there is a required catch-up contribution that needs to be made in the form of a Roth if you do make a catch-up for those who earned more than $150,000 in 2025. So not only are you dealing with that operationally, but then you're communicating that. And we've talked to our clients, and really my messaging to, even to the vendors, is instead of delivering this through the lens of the government says you have to do this, yes, we have to let them know that this is a requirement, but also giving them the foundational knowledge to understand, well, what are the benefits of having Roth dollars versus pre-tax dollars? And just because this is a requirement doesn't necessarily mean it's a bad thing. And I'd go one further, maybe we should be thinking about adding more money to Roth. So that's one example where there's a lot of very timely things going on. I would put that in the recent regulation and legislation category, also the tax mitigation category. I will get to it in a few moments, but tying Roth contributions to enrollment in a potential deferred compensation plan, we'll connect those dots in a minute. Plans have become more and more competitive thanks to fee disclosure. So asking your vendors on all of your benefits programs, what are you doing to win business? Why are new clients hiring you? And then my follow-on question to vendors is, what are the things that as an organization we should be taking advantage of that you offer other clients that we are not? So I'm going to try to communicate today in some action items. This is my first action item. At some point in preferably the beginning of 2026, I would reach out to your service providers, particularly on the retirement benefits front, and ask those two questions. Why are you winning business? You can also ask why you're losing business. I don't know if they'd give you a fair answer. And then what are the services and tools that you could be leveraging more effectively with that particular service provider? Oftentimes having a conversation like that you might be thinking the service isn't great, or maybe the value is not there. And maybe it really could just be a communication issue because your service provider has so many clients and maybe they think you already know about the things that they've been communicating. So that's my action item number one. Other things we're seeing: an aging workforce, but I'm going to bifurcate those who are working later in life because they want to versus those who are working later in life because they have to, right? And all day long, we want the folks, the former, right, where they want to be there. Perhaps there would be a brain drain if they left in mass. You're trying to figure out, how do you take their skills and their knowledge and impart it on your younger generations? The folks that are there because they have to, that's a tricky situation because, for one, they cost more from a benefits perspective, just the demographics, there's no getting around the numbers there. And then the latter is maybe they're not as productive as someone who actually wanted to be there. So I argue to retirement committees that it's not only, you might think it's altruistic to help people plan for retirement. No, it's good business sense. And it's going to help your bottom line to make sure that you are not accumulating employees who are at work because they have to be there and don't want to be there. Another nuance that is so very prevalent is this preference gap. And it's, how do we take one benefits program and allow it to meet the needs of 5 generations of workers? That sounds like an impossible math calculation. So we'll talk about ways to do that. Instead of thinking about generations, I like to think about, and we'll get here, I know it's, we each have a label, right? Everyone on this call, you're probably now looking in what category do you fall into. I would encourage you, when you think about providing benefits to your employees, think about it in the form of someone's life stage, not necessarily generation. Now, you might say, Kristen, it's semantics. Come on. From a financial planning perspective, there are challenges and opportunities that I would say the first life stage, early career employees have versus those who are, let's say, mid-career versus those who are pre-retirees. So we've started delivering communication and education through those three lenses. How would an employee who is early career maximize my benefits? And think of a profile of that person, meaning like a case study. So here are the factors about their situation, and here's how they would optimize our current benefits. That's the first exercise. And then think about, is there a void? Are there benefits that this life group in this life stage needs that we're not offering? So an example there is the idea of, let's say, student loan repayment. And what are you doing on that front? For some populations, for some organizations, that's very important. For others, it may not be. In the mid-career life stage, that from a statistical perspective, and when you survey employees, all of the surveys show that mid-career folks are the most stressed out, right? Otherwise also known as perhaps the sandwich generation. They're managing their career. Maybe they're in they're getting some additional responsibility at work. They've got more responsibility at home, a growing family. Maybe they're caring for aging parents. So there's a lot of things that they're juggling as they think about making financial progress. And then the third piece, the pre-retirees, it's maybe they're a little bit more confident from a career perspective, but now they're thinking about, how do I take my savings and my benefits and translate that into a paycheck when I no longer am receiving one? How do I give myself a paycheck in retirement? And if you think about the challenges and opportunities through that lens, you can ask yourself if the plans and the benefits that you're offering are truly meeting those needs. I will just hit on two others here, like the idea of employee education and engagement. That life stage ties right into that. You're going to hear more and more about investment options where you're creating an income stream. That's that phrase here, pensionification of the 401k. That's in the very, very, very early innings. And I know that there will be more to come there. And technological advancements. There's a lot of great things that are happening that allows us to receive information in a custom way. You think about logging into Netflix. Netflix already knows what you want to watch before you even know what you want to watch. That same technology allows your service providers to funnel information in a more targeted way to your employees. So that is one way you can lean on your service providers to help you deliver messaging of one corporate benefits program to 5 generations of workers, to folks in 3 different life stages. So that's kind of the backdrop. There's a few slides I'm going to point out for you to reference as you're thinking about planning for 2026. Every employee, just like every organization here, is going to have different goals. But from a strategy standpoint, as an organization, what are you rooting for? Where do you sit as it relates to recruiting? What types of employees do you need to be recruiting? What are they asking for? What does a competitive benefits program need for that group? How are you doing on retention? Are you retaining the right people in the right seats? What's your total rewards philosophy? From a tactical standpoint, I see more and more of my clients communicating benefits through the lens of a total reward statement, either through a service provider that helps you accumulate and compile that information, or if it's a smaller organization, maybe that's done in-house. But the idea of getting employees to think not just about their salary as it relates to their rewards. Are there ways to incent behavior? And that's where we're going to get into that non-qualified deferred compensation piece. And then how are you helping your employees save for their own transition, both within and outside the 401k plan? So these are the these are the dots that we're trying to connect today. We're going to dive in first on non-qualified plans. So you may be familiar with this. And I will tell you, as many of you know, we do periodic education meetings. For the first quarter of next year, we are planning a deep dive on executive deferred compensation plans. And there's lots of different structures. So consider the conversation today the 101 version, and we'll offer an opportunity for 201 and perhaps even 301 because they can get pretty complicated. And I don't mean that in a negative way. One of the benefits of non-qualified plans is that they are flexible. So unlike a qualified 401k or a pension plan where you have to be concerned about treating your employees the same, that flies in the face of non-qualified plans. You quite literally can offer different things to different people. There are some rules and regulations that you have to follow, a lot of it on the tax side. But the idea of being able to use this to retain and reward specific job titles, specific levels of income, that's something that is very, very doable. It does not have to meet the requirements of ERISA. It has fewer restrictions. Now, the tax treatment of these plans can get a little complicated. It is based on when the income is received from the employee's standpoint. So assets that are held in a non-qualified plan sit on the employer or the organization's balance sheet until they're paid out. So there's all sorts of ramifications about that. We'll talk about that. And I mentioned, of course, that it's flexible. So it can be as simple as a shadow 401k, where you just want to allow your employees, your executives, your highly comped employees to save above and beyond the IRS limits. It could be that simple. Or it could be as complex as saying you as the employer are willing to make contributions on certain employees' behalf based on different actions and incentives. Now, the reason why this is so very important is because of this concept that I call the retirement savings gap. So in the United States, most folks will retire with a combination of Social Security and qualified retirement plans. Now, back in the day, that used to include pension income. But where we sit today is that pension income for private sector employees has really gone away. And the limits, the Social Security benefits, and the limits that you can contribute to a qualified retirement plan are not based on a percentage of income. They are based on an absolute dollar amount. Now, when we think about how employees spend their money, because, right, the whole point of retirement savings is to save and invest so you have the financial resources to maintain your lifestyle in retirement, what drives that is an income replacement goal. So, I mean, I would argue that most people need almost 100% of certainly of their post-tax income, but in some cases, a high percentage of your pre-tax income, because most people end up spending more in retirement than they think they will, and certainly more than when they were working because they have time on their side. But that's a digression. So the purpose of this illustration here is to show you that as your compensation level increases in value, the traditional savings vehicle available in the United States, Social Security and a 401k, becomes less meaningful in helping your employees reach the income replacement goal that they need to get to comfortably retire. So it creates this gap. So the question becomes, well, how do you fill the gap? Well, you fill the gap in the absence of other non-qualified deferred comp plans with personal savings. That's just how it has to be. And that's not particularly tax efficient. So that's really the theory behind why offering these programs are so important. So from the employee's perspective, I'm going to walk through some benefits of these plans and then other considerations. I'm going to do the same thing for the employer, give you a few examples, and then we'll move on to the next benefit. So from the employee's perspective, if they are deferring their own dollars in a plan like this, you can make a pre-tax contribution And that contribution is deferred and the earnings are deferred until distribution. So it looks and feels like a 401k plan. Dependent on the structure, you can defer income much higher than 401k limits. So, you're making, let's say, $500,000 a year, saving 23,500 or 31,000 if you're over the age of 50 is a very small percentage. You could save 80% of your income, for instance, and that's going to be driven by plan design. It can be more flexible in choosing the investment strategy. And this is where I think it's really powerful from a financial planning perspective. You can choose to have payouts, again, if the plan design allows for it, both in service, meaning you're still working, and post severance opportunities. So I'll give you 2 examples. Let's say you're someone who's in that mid-career stage, and you're not only saving for retirement, you're also saving for children's college education. Well, you could use a deferred compensation plan if it allows for in-service distributions where those dollars are going to vest and pay out to you at specific dates in the future prior to you leaving the organization. So you can use it to fund and plan for goals other than retirement. Perhaps you want to buy a second home. You could use it for that purpose as well. In the post-retirement scenario, I like the option of using a deferred compensation plan to give you an income stream in your early years. Now, from a cash flow management perspective in retirement, you've got some decisions. One is, when are you starting to take Social Security? And there's all sorts of math involved in that. And then the second is, when are you going to start to take distributions from 401ks and IRA accounts to fund your lifestyle? Well, many people want to delay Social Security as long as possible because beyond your full retirement age, you get an 8% kicker each year until you reach the age of 70. So if you think you're going to have longevity on your side, that can make sense. On the retirement plan and the IRA side, the minimum required distribution today is 73 years old, and that's going up to 75. So let's say you retire at the age of 65. You don't want to take Social Security until 70, and you'd love to let your IRA sit until you're 75. Well, what if during your working years, you saved in a non-qualified plan that was structured to give you annual payments between the ages of 65 and 75? You just created a pension-like income stream for yourself. Yes, that distribution is going to be taxable, but it's going to feel like a paycheck. And that mentally really helps a lot of people from a planning perspective. So I've only really talked about the benefits of this. Now let's talk about some of the considerations. Well, a balance in a non-qualified plan is not eligible for a rollover like a qualified plan. So when you sever from the organization, that tends to be a taxable event. It is also not protected in the event of bankruptcy and is subject to creditors. As I mentioned before, until it's actually paid out to the employee, it is a corporate asset. And unlike a 401k, where you can choose to change your deferral rate any point in the year, you have to make a decision in advance of earning the income. So for instance, the open enrollment windows in the fourth quarter of 2025 are informing what you can save in plan year 2026. So those are things to consider from the employee's perspective. How about the employer? Well, from the employer's perspective, you're making a more competitive benefits program. And particularly as you go upstream in your hiring, you might need to offer something like this. It can help with retention because people want to stay on board to continue the benefit. You can discriminate in favor of key employees, and it's much easier to administer than a qualified plan. There's no plan testing or IRS filings if they're set up properly. However, there is regulations that you need to follow, and that's what we call 409A requirements. It means that you need to have a written agreement in your plan that the deferral and distribution elections must be made, as I mentioned before, in the tax year prior to those in which the amounts are earned. And you need to have some specific language and execution around restrictions for distribution election requirements. So meaning if you're going to, and this actually is a benefit to the employee, when you contribute, you're making your election on how you want the money to get distributed, but it's not a life sentence. It's not one and done, meaning that you can go in, and as long as you're pushing out the benefit date at least 5 years, the employee can make a change. So those are all options that you need to make sure that you are executing on and making sure that the plan is running in that capacity. Now, the other caveat here is that for taxable entities, the tax deduction is deferred until benefits are paid. So unlike a benefit that you're paying in real time to an employee, a salary, a bonus, that's a deduction. If the bonus goes into a non-qualified plan, you're not getting a deduction for that until it gets paid out of the plan. So there's some tax considerations there. I'm going to compare here. We've touched on a lot of these bullets, but the comparison between a 401k and a non-qualified deferred compensation plan. Well, let's talk about the similarities. They both offer an income deferred distribution subject to FICA and Medicare. The employer can make contributions and participants can choose their own investing strategy. Different from the 401k with a non-qual plan, contributions are not subject to statutory limits and not subject to discrimination testing. In the 401k, they are formally funded. A non-qualified deferred compensation plan does not have to be funded. In many instances, they are in fact funded, particularly if it's an employee deferral plan, but it doesn't have to be. And plan balances in the 401k are secured from the claims of creditors. It's held separately in a trust, and it's not, 401k assets are not the asset of the company, they're the asset of the employee. Participants restricted to highly comped, so you can't offer a non-qualified deferred compensation plan to just anyone. It needs to meet certain criteria, the top percentage of your population as a maximum, usually around 20%. And scheduled withdrawals prior to age 59 and a half, if you were to do that in a 401k, there would be a penalty or it would be absolutely restricted. In the world of non-qualified deferred comp, you can allow for distributions prior to separation of service. So let's wrap up here by thinking about how the non-qualified plan can meet multiple objectives, helps with recruiting, deferring salary bonus. There are non-qualified plans that you could structure with restricted stock units or RSUs. Lots of detail, lots of specialization here. From a reward perspective, you can incentivize folks based on performance. To the extent this is a very tactical use of a non-qual plan, if a participant for some reason missed out on matching contributions, perhaps you have a testing issue in your 401k. Sometimes this exists with smaller plans. If the non-highly compensated population does not have great savings or participation, that could cap the amount that your highly compensated employees and key employees can contribute to the plan, regardless of what the IRS may say about the limit. And in that instance, we've seen clients use a deferred comp plan to kind of fill that gap. So if you're going to get a refund, then let's set it up to automatically you take your refund that you're receiving in your 401k and put it into your deferred comp plan. So you're maximizing the potential deduction. From a retention standpoint, you can apply vesting schedules. It can be rolling, where each annual contribution vests over a pro rata period. And that really is, the goal is to reduce leakage, making sure that employees stay, or at least those that you want to. This is another slide here that I'd suggest is a great slide to come back to, because it asks some questions that can help you determine what an appropriate program might look like. Perhaps you offer something already. So I would just run through this and ask yourself, does what exists now meet the goals that my organization is trying to meet for the future? So you're defining who can participate, what types of comp can be deferred, How are they allocated? Is the company going to contribute? Is the plan going to be funded? What are the investment vehicles and what are the distribution options? So those are kind of the highlights of the key provisions that go into any thoughtful non-qualified deferred comp plan. I mentioned that they use it to 401k match-up contributions, true-up contributions, performance-based contributions, an alternative to equity in the business, particularly for a privately owned company. You want to keep key talent, but you don't want to necessarily dilute the equity. This could be a great use case for that. Sign-on bonus, vesting schedules, all of that. I mentioned when we started that there is some legislation, Secure 2.0, depending on your role, you may be sick of hearing about Secure 2.0, but January 1st, that Roth required catch-up. What we've seen from an education perspective that has worked is tying the Roth requirement to the election and enrollment in a non-qualified deferred comp plan. So I'll give you an example. Let's say you're losing out on an $8,000 deduction because that's the catch up for next year. And now it needs to be made in the form of the Roth. Okay, well, you don't have to lose it. You just need to make sure that you're deferring into your non-qual plan that $8,000 or even more. So we've used it to highlight the benefits of the plan and perhaps boost enrollment. Now, the reality is where we are in the calendar, it's December 19th. It's likely too late for 2026 income. But you think about what does your employee education look like? I should say, unless you have a separate enrollment period, let's say for bonuses. We have some clients that have a mid-year bonus election. This is something for you to think about for education and perhaps even offering executive financial planning services for those eligible for a non-qualified plan. It's one thing to offer a plan. It's another thing to actually ensure that your employees are using it and appreciating it. And that's where making sure that whether it's you or advisors are kind of connecting the dots for your employees on how to maximize your offering. Health savings account. Okay, now we're going to transition from our retirement hat to our HSA hat, which lives in the world of medical plans, but I would argue should be thought of as another retirement account. Not necessarily for every employee, but certainly for your executives and for your higher income earners. Even for those who don't fall in that category, thinking about when and where you cover your health expenses makes sense. A colleague of mine actually presented on this topic at SHRM's 2025 conference in San Diego and ran a panel. And one of the panelists pointed out that the medical world did an awful job when it comes to the PR around high deductible plans, right? Who wants to participate in a high deductible plan? What if we changed how they're positioned and instead of calling it a high deductible plan, we called it a low premium plan? Think of that shift in mindset, a low premium plan. Okay, well, what do I get for a low premium plan? Okay, you get lower monthly premiums, obviously. You do get a higher deductible, but let's not lead with that. And you also get the ability to save in a health savings account. And if you think about how in the retirement space, we've gone from a situation where there was pension and Social Security to the worker being almost entirely relying upon their own savings plus employer contributions for their retirement nest egg. That fits the nature of our employees, which tend to be a more transient workforce. You're not necessarily starting and ending your career at the same company. In fact, that's the anomaly today. Well, a similar shift is occurring in the medical space, where the cost of medical plans, as you all know, probably even more than I do, that is a multiple of what it was in the past. Many have to have employees take a share of the risk and more so. So I mentioned before the liability of having an aging workforce, and I don't mean that from a discrimination standpoint, an aging workforce that wants to be at work and has skills is a wonderful thing. But if you've got folks who are financially unprepared to retire, that's another story here. So when we think about workforce costs, you should be thinking about what is the cost of keeping someone on past our normal retirement age, and educate folks to save for their future so that they can afford to. So let's talk about the power of the HSA. HSA and FSA, unfortunately, are too similar when we think about where they're kind of what we think about where we stash them in our brain, right? FSA is a flexible spending account. So I think a lot of people assume that the S in HSA is a health spending account, but no, it's not. It's a savings account. And the HSA is the only type of account, at least in the United States, that has the potential to be triple tax advantage. Never, ever, ever paying taxes on the money that gets into an HSA. It's a pre-tax on contribution. It's tax deferred on growth, and you can choose to invest. And then if it's used for qualified medical expenses, it's a tax-free withdrawal. Now, forgive me if this is elementary and you already know this, but the withdrawals do not necessarily have to be of an expense that you incurred in the year you take the distribution. In practice, what does that mean? Let's say I have, I don't know, surgery in 2025 on my foot, and I pay for it out of pocket. In retirement in 15 years, I can take the cost of that surgery out of my HSA, reimburse myself. In the meantime, the money was invested and grew and compounded for 15 years. That is the power of compounding interest. It can be used to pay future healthcare costs in retirement, Medicare premiums. Think about that. Fidelity actually has some pretty staggering surveys and estimates of what the average couple who reaches age 65 is going to spend in healthcare costs. And it used to be estimated at $250,000, and now it's over $300,000. So that is meaningful. Those are big dollars. So why not position the HSA to be the vehicle that's going to support that and completely negate the use it or lose it rule? Unlike the non-qual plan, there is portability. It can be ruled over to another HSA custodian if you do change jobs. Now, we are still in the early innings of the HSA being used to its fullest potential. Less than 10% of HSA assets are invested. Most of them are sitting in cash, meaning new dollars coming in. Most of new dollars are going into cash. In terms of the actual assets sitting in accounts, about a quarter of them are invested. And this is staggering. Nearly 70% of employers themselves don't even understand how to optimize the use of the HSA. So I'm going to give you some examples. What is a good use of the HSA? Well, let's say you're contributing the amount in your HSA of the medical expenses you expect to incur within the year, and you use it as needed. Okay, so that's pretty good. You get the deduction for the contribution, and you're going to get a withdrawal that is tax-free, 2 of the 3 tax benefits. Okay, so if you estimate that your child's going to need $3,000 to put braces on, you contribute $3,000, you take $3,000 out to pay the cover of the braces. What might be better? Okay, well, you contribute more than the expected annual medical expenses with the idea that you want to build the account to cover the deductible, 1 or more years, or even beyond that, 1 or more years of maximum out of pocket expenses. And that certainly reduces the financial risk of a major health issue that you might have. So that's creating a cushion, so to speak. Now, the best way to use it is to contribute at or near the maximum and invest most of it for the long term. Now, the reality is there are things that are pulling at our purse strings at all income levels, quite frankly, but certainly at the lower income levels where maybe they've not benefited as much from market performance, and even though inflation has slowed down, it certainly hasn't gone back down to where we were prior to 2021. And we're struggling from a cash flow perspective. This best scenario may not be realistic for all your employees, but it is realistic for some. So making sure that there's the education that this is happening. I just saw a question in the Q&A. Yes, absolutely. This is being recorded. It'll have to go through my compliance team, but then I'm happy to share it back out to you when it is available. Cash balance plan, I'd say of the three types of plans that we've talked about, this probably has the smallest use case, but when it's appropriate, it really can be very impactful. So cash balance plans are this hybrid plan where it's a qualified plan, so it meets the requirements of ERISA. It is a plan that is kind of this hybrid where it's a defined benefit plan, but also features of defined contribution. There's tax and cost efficiency. It is protected from bankruptcy. It is helpful to attract and retain client. Now, this is unlike deferred comp plans and HSA plans, cash balance plans tend to be sector specific. They're very impactful for healthcare firms. I have many medical practices who use this. Finance companies, some construction companies, professional services companies, they make up 3/4 of all cash balance plan sponsors. So let me compare and contrast the two. In the case of a traditional pension plan, the employer bears investment risk. The employer signs on to pay out a specific benefit to their retirees for the rest of their life. So they also bear the longevity risk. And the value is often not appreciated by the employee, particularly in a workforce where you tend to change employers. In the DC space, the employee bears the investment risk. The benefits can be unpredictable depending on when you retire relative to how strong or weak the financial markets have been. And because it's a pot of money, it's not a particularly effective vehicle for creating lifetime income stream, at least not the way they're currently structured. In the cash balance space, the employer is responsible for the investing and will commit to a rate of return or a crediting rate to the employee. However, not for the rest of their lives. It's not an income stream. It's a lump sum. So it's kind of a hybrid here. Now, the reason why you might offer this is because you can contribute a multiple of what you can in a 401k plan. So a typical design here, like the medical practices, you can allow your doctors to defer, let's say $50,000, $100,000, even more. In return, there's an actuary involved that gives you a specific calculation. For you to defer this dollar amount, you have to contribute to your other employees a certain amount, but it can be much less. So that's why cash balance plans are very specific to the population. So if you say, you know, Kristen, I'm interested in exploring this, the first ask would be, okay, give us a census. I don't need names. I don't need socials. I need ages and income for your population. And then we can work with our actuarial partners to work up whether or not a cash balance plan might make sense for you. Okay, so we're going to wrap up just another 5 or 10 minutes on financial wellness, which is really kind of the bow that we're wrapping all of this in. Because in the absence of coordinated communication and tools and resources, these programs may not be particularly effective. And why is that? Well, employees spend on average 8 hours a week dealing with financial issues. And we found that half of those actually occurs at work. So you can make an argument that providing financial training is making your employees more productive because maybe they have to spend less time at work on that. In this age of thinking about the whole employee, thinking about the health, the physical, the mental, the social, the financial health of your employees, what has become so apparent is how interconnected financial and mental health are. One of my favorite analogies is that WebMD now actually has financial health as a health issue that they research and educate on. The Columbia University Medical Center has an entire group of professionals dedicated to this research. And what they've found is that financial stress impacts physical stress, which also impacts mental health. Okay, so you're probably thinking to yourself, how on earth am I supposed to, as an HR professional, a finance professional, a business owner, be expected to solve the challenges of my employees' financial, mental, and physical health? It's too much of an ask. And I agree with you. The good news is that you don't actually have to have all of your problems solved to see a material impact in your mental health. Actually having a plan for progress is just as important as executing the plan as it relates to how we deal with stress. So the feeling of helplessness is really where everything unwinds, where you feel like you don't know what your next right decision is, therefore you can't get out of whatever situation you're in now. And I know I'm kind of like broadening this out, but it speaks to identifying your financial challenges and opportunities. You know, when we do employee education, I'm a big fan of the theme, where should my next dollar go? Okay, what is my next right financial decision? We're not going to solve all your financial issues this year. We might not even solve them the next year. The reality is financial issues exist at all income levels, at all ages. You might have your finances figured out in your 20s, and then you start a family and it becomes more challenging. You might be doing okay mid-career, you get closer to retirement. Now you're going to have to manage, Medicare, Social Security, what have you. So the fact that financial stress is apparent and challenges are there is not something we can solve. How we can solve is having a plan for dealing with it. So when you think about your financial health, I'm going to give you a couple slides here that could help you think about the prism through which you should be building both for yourself and for your employees. And it's thinking about your financial health through the lens of spending, saving, borrowing, and planning. And here I outline eight parameters. Spending less than income, paying your bills on time. Some of this is stating the obvious, but people need to hear it. Having sufficient liquid savings. Confidence in meeting goals, thinking about good debt, bad debt, understanding the financial opportunity cost of taking on credit card debt that's suffocating, understanding your credit score and ways to improve it, thinking about insurance as risk mitigation. So when you think about the fact that you probably offer life insurance, for instance, as part of your benefits, are you communicating that to your employees as a risk mitigation benefit? Are you offering, and this is where I'm going to come full circle. At the beginning of our program today, I suggested that you have conversations with your vendors about how they could be doing more for your employees and what they're winning new business on. There are a lot of great tools and resources that, thanks to technological advancements, are now available that can help with this financial planning realm. Coming back to the financial needs and priorities evolve over time. I mentioned this early life stage, mid-life stage, later life stage, whatever you want to call it, early career, mid-career, pre-retiree. The reality is that our needs and priorities evolve over time. Let's normalize that as we talk to employees about their benefits. A lot of it is also sympathizing. And I will tell you that this is full circle, 180 degrees different from when I first started, where employers wouldn't go near talking about someone's financial health with a 10-foot pole, right? This is a private conversation that doesn't live in the workforce. Well, as the lines have blurred between work and home, and as employers are being asked to do more and more for your employees from a wellness perspective, being able to acknowledge and perhaps support the challenges that your employees are facing has become not only an expectation, but good business sense, because productive, supported employees tend to stay. I ask, and if you're thinking about, well, where do I even start with evaluating whether or not we're educating our employees the right way? Four questions that I believe every investor, every worker should be able to answer. What are your financial goals? And short-term goals, intermediate-term goals, long-term goals. What is my cash flow? Sources in, money out. If I get a raise, where's that next dollar going? And what is my investing strategy? What is my split between stocks and bonds? Now, in summary, this is the third slide that I'd encourage you to go back to and share with your colleagues. And it's thinking about taking this financial wellness umbrella and understanding what falls underneath it. So whether it's a pre-tax 401k, adding after tax to a 401k. So this is beyond the Roth. This is actually being able to add an after tax money source that can be converted to more Roth dollars. Really impactful. There are testing implications for your 401k. And of course, the title of this program was Beyond the 401k, but I would put this in your quiver if you have folks who are looking to save more and maybe you're not ready yet to jump into a non-qualified plan, considering adding that after-tax money source. HSAs as a great way to have tax advantage growth for a very important need, which is health costs. That cash balance plan is a kind of a niche plan for the right organization, and then the non-qualified plan to recruit, retain, and reward employees. With that, I would like to open it up for any questions that you may have. Feel free to type it into the chat, and we will go from there. As I mentioned, you will be receiving a copy of the slides. You also will be receiving a recording of this program. This is kind of one of those a mile wide, maybe, I don't know, 10 feet deep kind of conversations. We casted a very wide net. I can and have done specific programs on any one of these pillars here. So if you would like a deep dive, definitely feel free to reach out. I am getting a question about refunds on 401ks. I see that, yes. So that can be tricky. There are a few ways to handle 401k refunds. And what I mean by that is after you complete your discrimination testing, if you fail the test, and again, I hate back to PR 101, I hate that phraseology. You didn't fail a test. It's that your non-highlies didn't save as much as you needed them for your highlies to save. There are ways to combat that. An expensive way is to make a contribution to all of your non-highly employees. That's called a QNEC, a qualified non-elective contribution. I see very few companies doing that. You can offer automatic enrollment. And actually, new plans today are required, believe it or not, to have automatic enrollment with automatic increase. That could help your testing issue over time, but not immediately. And then you could also cap the amount your highlies can contribute. You might look to current year plan testing versus prior. And then if none of that works, offering a non-qualified plan is a great supplement. Okay, another question. If an employee maxes out their 401k pre-tax and catch up, are there any other retirement planning options they can do on a pre-tax basis? So if they qualify for the non-qualified plan is where you would want to do that. So if they could possibly fall into the category of executive management or for highly comped folks, a deferred compensation plan does exactly that. And you have the ability to defer a multiple of what your existing 401k limits are. Beyond that, no, there really isn't. So that's why we're kind of coupling the required Roth catch-up conversation with the non-qualified plan enrollment conversation, because it's a way to maximize the pre-tax contributions. The other, I didn't say it as I was describing it, but it's here on the slide. You might have heard about the phrase backdoor Roth. And that's the idea, that's this after-tax 401k, where you're making an after-tax contribution, which if you just let it sit, those dollars would grow tax deferred, meaning when you take the distribution, you're taxed on the growth. But based on current tax law, you are allowed to immediately convert your after-tax contribution to a Roth within a 401k plan. But that is considered, those after-tax contributions are part of your ACP test. So you just want to be sensitive to, great, you offer this benefit, but if all of your Hileys take advantage of it, it could make your plan testing out of whack and you could end up giving them refunds. So something to be aware of there. I have one other question on cash balance plans and the crediting rate, what that is. It's actually dependent on plan design. So historically, the crediting rate I've seen tied to a rate of return, a conservative rate of return, let's say the 10-year treasury yield. I've also seen it tied to just an absolute dollar amount. It's 4%. That's the crediting rate. And then the flip side is that the organization has to invest its contributions so that they're meeting that 4% requirement and able to pay the benefits over time. Something that's relatively new in the cash balance space is the ability to have a market-based crediting rate, so tie it more to the stock market. Kind of related but different topic. If you follow the markets, if you follow your 401k, you're probably pretty happy with the balance, particularly versus where you were in 2022. We'll see what happens in the next 10, well, I guess it would be the next 8 trading days between now and the end of the year. But the markets look like they're going to have a third year of double-digit growth. So balances are high. In my experience, like we for many of our clients, we do education and employees can call us with questions. We're getting very few questions about performance. We're getting very few questions about where they should invest in. People are just feeling good, which the contrarian in me gets a little nervous. Our messaging and education is that, what goes up must come down, right? If you're taking risk at some point, yes, the markets are doing well, it could back off. And not only, and this is where the education comes in, not only should that be expected because we don't want you to harm yourself by selling at a low and get scared out of the market. Next level is viewing a sell-off as an opportunity to boost the amount that you're saving because you are buying more shares. During any type of market dislocation, I encourage investors to look at your statement. Yes, the market today is valuing your assets at 15%, let's say, less than it was a year ago, but you have more shares today. You own more assets today than you did, and the market valuation can be very fickle, right? We get a valuation every minute, seemingly, of every day. Good and bad thing with that. So as you think about building your own financial plan, just keep that in the back of your mind. That's why from a tools perspective, I would end with the importance of a rebalancing tool, a rebalancing function. We are seeing the lion's share of 401k plan assets are going into the target retirement date fund space. And there's good and bad with that. Good news is that target date funds, even at very early vintages, have allocations to stock. And because the markets have done well, a lot of target date funds have done very well. They are rebalanced intra-year, so you stay at your target allocation. And that's all done within the cost structure. The bad side of the target dates is that people might think that they're guaranteed to have a certain amount when they get to the date in that fund. And of course, we know that's not the case, right? That they can go down in value. So for the folks who don't want to engage on the portfolio, I think target dates work well. There's also almost all vendors have the ability for employees to set up an auto rebalancing feature within a 401k, within a non-qualified plan. A little less so on the HSA front. HSA investing is where 401k investing was 20 years ago. So I expect that to continue to get better from a pricing standpoint and from a tools perspective. But thinking about that, and I think about educating your employees about making decisions for investing within the 401k, the HSA, and a non-qualified plan in totality. So I was pretty flexible in terms of the topics that I covered today. So thank you for your patience as we covered many different areas. We are at the bottom of the hour. I will be sending shortly the email with the slides and with the code. And of course, reach out with any questions or areas that you'd like to explore further. I wish you all a very wonderful holiday season. I know it may not always be the case because you're so busy, but finding time for some fun, relaxation, and recharging for 2026. Happy New Year. Take care.